Well, thank you very much. This is kind of my first foray with TradeThirsty, and looking forward to the association. And thank you for your confidence in having me as a presenter. So welcome. My name is Mark Shawson, the Pattern Trader. I'm going to use the format I typically use for what we have every week as a two-day boot camp. So I'm just going to go through the same screenshots if you don't mind. I've entitled this presentation "How to Capitalize on Big Moves and Market Reversals in the Forex Market," but hopefully after my presentation you'll come to understand that you can use my very simple price action and price pattern trading methodology to trade just about any trading market. So if you're trading the stock market, if you're trading live cattle or pork bellies on the commodities markets, or you're trading the FX market, you will be able to use this methodology. Now again, I've entitled this presentation "How to Capitalize on Big Moves." And let me show you what I mean. I'm going to show you a couple of months of trading. So this was last March. So I know a lot of FX traders are trading 5, 10, 15 times a day. I might trade 15 or 20 times a month. I'm just looking for the very high probability trades, the trades that will extend for big moves. And so this way I don't really need to win most of my trades. In fact, you'll see, again, this is the month of March. I made 20 trades and I lost half of them. I lost 50% of my trades, but I still made 1,097 pips, almost 1,100 pips, and that's not a typo. There's so many out there who trade FX who, are looking for 5, 10, 15 pip gains, and to me, A, this doesn't make sense to me, and B, I doubt you can be very successful long term, if you just have that kind of outcome where you're risking 15 pips to make 15 pips, then you've got to overcome the broker spread. And again, I think that it's really a folly to think that you'll be successful over the long term. So I just need to find one or two big trades a month that put me in the winning column. And as you can see, in this particular trade in XAU USD, this is spot gold. I made 380 pips, and actually at the time that was on, I made another 170 pips. So actually I made 550 pips on that one trade. And then in this Euro New Zealand trade that I sat in for 11 days, I made 474 pips. So, effectively on two trades, I made, what I made for the whole month, and then the rest of the month was making, losing, giving back, etc. And this is, very common with trading. You're not going to not lose. But by winning big on a few trades, it puts you firmly in the win column. And, I'm going to show you how I do this to average about 500 or 600 pips a month. Lately, I've done a lot better. April, I only did 14 trades, but I made 1,250 pips. Let's see, May, I lost like 10 out of my last 12 pip trades, and I still made 739 pips. Again, I made 510 pips on a pound yen and another 650 pips in XAU USD, which put me in the win column. And so it went for June, 769, and even July, a slow month, but I'm still in the win column. Now, I realize anybody can show you numbers on a spreadsheet, but this is my trades that I send out to literally thousands of people, thousands of my members around the world. So every day I send out an email, every week. This was a Sunday email that went out. I typically do an overview. I typically do a video report, 25 to 30 minutes, showing you what my thoughts are on the market, how to manage any open trades. And again, this was a trade that I sent out March 5th at 1:08 p.m. And typically I show you the analysis on the chart that I'm looking at, where I'm looking to enter and why, and then I actually write up the trade. So here was an entry in the pound New Zealand, a buy stop at 175.09, and then I always again include the reasons I'm looking. There was a double bottom price pattern. There were several key reversals that I'm going to talk about, and then I basically said prices can only head higher, much higher from current levels. So again, we entered that trade right here, March 6th, and I got out almost 2 months later. So I'll hold a trade for as long as it will go. So this was the pound New Zealand. I got long at 175.09, and I got out almost 900 pips higher, 900 pips on a single trade. I actually added to that trade on April 3rd and made an additional 556 pips. So effectively, I made about 1,500 pips on one pair over the course of a few months by just staying in that trade. So this is my trade total for weekly trades since March, and this is the trade total for my daily trades that go out every day. Now, I know a lot of you may not be FX traders. You don't know what a pip is. A pip is a unit of value. It's like a price movement in a stock. It's a minimum increment, and the pip will have different values depending on your lot size, but no matter what lot sizes you were using or what account size you had, if you were trading very conservatively, you would have made over 100% in the last 6 months taking my trades. So that's a brief overview of my trading. So let me kind of slip into presentation mode and kind of go through my charts really quickly here. So again, I'm going to show you how I come out with a 400 to 500 pip profit every month and how I do this consistently. So today's agenda, I'm going to reveal a little bit about how I got started trading. You'll discover my very simple price action, price pattern trading methodology that consistently pulls in huge gains over the long run. I'm going to show you real trade examples like a pound yen trade that I pulled in over 652 pips in just a few days. How to spot a market coil that would have yielded you a quick 154 pip winner in dollar versus yen, and many more real-time trade examples. And how many traders, how many members are following my information and using my information to make big monetary gains every day. But before I continue, I'd kind of like for us to be on the same page and have you agree that hanging around, seeking advice in internet forums is not how you're going to make money long-term in the markets. I would also forget about what we call EAs. These are trading robots. I assure you, if there was a robot out there that could make you money week in and week out, Goldman Sachs or JP Morgan would be paying billions of dollars for it. And it's kind of counterintuitive to think you can go on the internet, buy something like that for $147 or $350 or whatever they're asking, and have them make you successful over the long run. It just doesn't happen. You have to effectively want a system that works forever. Not 6 months, not 12 months, but forever. So unfortunately, most people don't make money in the Forex market, and here are a couple reasons why. I suspect they're just looking for the quick, easy buck. Forex is, leveraged, and they think they can run, 1,000 to 100,000, and it just doesn't happen that way. Most people are looking for the bump, the rush, or the action, and or they're using trading strategies that don't work over the long term. So inevitably, they probably just aren't interested or capable of what it really takes to be a successful trader, which is a healthy dose of disciplined patience. And so just because I'm making a lot of money in the market doesn't automatically mean that you will. Having said that, there are a lot of people on this webinar right now who are looking at this strategy, and it's because they're hungry and committed to success. So I'm the fellow on the left. The handsome guy on my right is my son Elon. My son gives me every reason I need to wake up in the morning and be committed to what I do. I'm also known as one of the most successful pattern traders in the world, with thousands of traders following my analysis online today. I'm just going to do an abbreviated version of my bio, given this restriction of time. I got started, trading in 1980, so I've been doing this quite a while. I was in my last year of college. I was at USC Business School. I met an investment banker named Graham Loving, and in addition to his investment banking activities, Graham at the time was also actively trading the commodities futures markets. Cocoa, soybeans, live cattle, you name it. And it wasn't just the way he was trading and how successful he was, but how he was making his money in the markets. Remember, I was at USC Business School. I was learning fundamental analysis, how to break apart an investment by looking at all kinds of fundamental metrics, balance sheets, price-earning ratios, etc. And Graham was making money hand over fist by just looking at technical price action. And again, this was the days before the internet and fancy charting services. He would just go down to the corner grocery store and buy a sheet of graph paper and plot an X and a Y axis with price and time. And every day he would just plot the closing price of live cattle or cocoa or soybeans. And after 3 weeks, he'd say to me, Mark, I just want to buy a market that's going up or sell a market that's going down. And that was my introduction to price action trading and how to make money by looking at charts. And obviously, over the last 30 years, I've created a technical trading system that, I effectively leverage for myself and is authentic to myself. I made a lot of mistakes, learn what works and what doesn't work, and this is hopefully what I'll present before you today. So effectively, at that time, Graham and my dad started a $500,000 trading account, and Graham ran it to $5 million using his technical trading methods. So obviously, after I saw this, I knew what my passion was going to be. I knew what I wanted to, do for a living, and I started working for a lot of investment firms, not so much as a commission agent, but to learn how to make money for myself and others. And eventually, I went on to an institutional career where I handled the money of high net worth investors, institutions, etc., for major Wall Street firms. Then I kind of unfortunately got involved with an SEC investigation due to some false information that was propagated by my brother, and it effectively ran me out of the business. But it was the best thing that happened to me. My son was born at that time, and I started using my knowledge to trade from home, and I took a very small 5-figure account and ran it to a very big 7-figure account using these strategies. And then in 2015, I started the Pattern Trader, September 2015, with my partner Peter Visser, and we have thousands of clients worldwide. You can actually go to a review website. There's well over 200 reviews, and you can see what other people have to say. You don't have to hear it from me, but effectively, there's not one person who started with me in September 2015, not a single person that has lost money if they took every one of my trades. So let's get into exactly why most traders lose. I think you heard in the last presentation somebody asked, or a question, I've heard that 95% of people lose their money in the markets, and that's probably correct. And it's just because there are a lot of misrepresentations, there's a lot of false notions, and especially in this online world, I start noticing that most of the things out there you've been taught are just simply dead wrong. I think the first big myth or fallacy or lie, if you will, is that most internet marketers will have you believe that their past results mean that you can make money using their systems. However, I promise you that the real pros on Wall Street don't use these kind of, retrofitted result systems. They analyze the core strategy, dissect it, and then see whether it actually makes sense over the long term, and then they test it themselves. So the question you need to ask after this presentation is, do you understand this methodology? Does it appear logical? Does it appear to have longevity? And does it also have a unique edge? And ultimately, can you replicate the trades? So the other big myth or lie is you need to win most of your trades to make a long-term consistent income. And as I just showed you on my trading, many months, in fact, I think for all 2016, I was less than 50% successful on my trades for the month, and yet I still came out with over 5,000 pips for the year 2016. I think most people need to win on most of their trades only because their risk reward is too small, so that they do need to win on 80 or 90% of their trades. So if you're looking to make 5 or 10 pips on a trade and you're risking 5 or 10 pips, the math tells you have to be successful 90% of the time. But again, I think this is not sustainable. Most people are not going to be 90% winning, so you have to alter your strategy. So, and I'll prove this to you in just a moment. So most of my trading strategies, as I said, out there are simply not designed with an adequate risk reward ratio, and I'll speak about this in a moment. So most of my trades have a 3-to-1 risk reward. So that means if I'm looking to risk 50 pips on a trade, I need to see at least 150 pip outcome to put that trade on. And the math will show you that you can actually lose 72% of your trades and still be a winner with a 3-to-1 risk-reward ratio. So this is, again, a screenshot of my trades back in November. Again, 1,100 pips, losing most of my trades in that month. So I said on a lot of webinars just to familiarize myself with what other people are doing in the industry. And I kid you not, a couple of weeks ago, I was sitting on a webinar, and this was the chart that I saw before me. And I suspect maybe a lot of your trading screens are looking like this, where you're trading some instrument on a short-term basis with all kinds of overlapping what we call lagging indicators, stochastics, Bollinger Bands, MACD, moving averages, etc. And, you know, I don't know about you, but after about 10 minutes, I had to hop off the webinar because my eyes were crossing and I was getting a headache. Instead, this is what I look at. This is what's called a clean or a naked chart. And the reason why we call it a naked chart is you'll notice there are no indicators, no stochastics, no Fibonacci's, no moving averages. So I'm just, it's not even a candlestick chart. I'm just looking at high, low, and close. So you'll see on this chart up here was 92, and it fell to a price of 79. So this is a, you know, $21,000, I'm sorry, an $11,000 move for every $1,000 you put up. And this is what I'm looking to do, is to take a huge chunk out of the middle of something like this. And then when the market based out at 79, went to 87, that's another $8,000 move. And again, I'm looking to take out a healthy chunk out of the middle. And this is what I look at. So this may be a little bit redundant for some of you, but this is a daily bar in detail. I look at you know, charts principally on the daily time frame. I also look at weekly and monthly. I look at pretty much longer term because, again, I want to see the forest for the trees. I'm looking for the bigger moves, and you just can't see the bigger moves on a 5 or a 15-minute chart. So you know, just to go into this in some detail, this is the low of the day, this is the high of the day, and this little slash mark indicates where the market closed. But to me, it also indicates that the buyers won the day on this particular day. And while I don't just look at one bar in a vacuum, I look at it in context of the main trend or an established chart pattern. But that, you know, I put a lot of importance of where a market closes because, again, it tells me who won the day. This is an example of where the sellers won the day, where you had a high and low, and the close was lower, closer to the low than the high, again, indicating that the sellers won the day. And we're going to be looking at a lot of charts today, so I'll make that a little clearer in a moment. So in a nutshell, this is my price action, price pattern trading strategy. So typically you've been told that there are 3 phases or conditions that the market can be in at any one time. Market can either be traveling up, trending lower, or thrashing around sideways. I'd like to add a couple of other nuances, and frankly, this is where I make most of my money. This is when the market is reversing or turning from one phase or direction to the other. In this case, we see a market that is bearish or going down, puts on a chart pattern we can recognize, and then shoots out and goes the other way, goes higher. This is a market that was going higher, puts on some kind of chart pattern we recognize, and now it goes the other way. And this oftentimes catches a lot of market participants by surprise, but to my mind, there's always a chart pattern that indicates this reversal, and I've been pretty adept at jumping on these kind of reversals. So again, I'll trade all, you know, conditions: an up market, a down market, a turning market from down to up, or up to down. What I try and avoid are these sideways markets. To me, this is just gambling. It's pretty random, and then our risk-reward outcome is not as robust as we can see in other times. Now, sometimes the market just goes into these churns. This is all that we're offered, and in these cases, you know, I just try and, you know, reduce my trading. Again, I just want to stay out of this kind of boxing match as much as I can. So either there's a trending market or there's a reversal market. And if there's a reversal market, there's always some kind of chart pattern that precedes that reversal. And while you can consult any textbook or charting website for historical price patterns, I'm going to share with you 5 primary patterns that I look for. And I'm sure you've seen these before. The first is the double top or the double bottom, just as it sounds. The double top is where market was going up, it peaks, comes off, retests that peak, and then when it crosses the neckline, which is simply a line drawn through the chart pattern, it indicates a reversal market. The opposite is the double bottom. This is where market comes crashing down, makes a low, bounces off the low, retests the low, and then when it cracks through the neckline, it forms this W or double bottom. So these are indications of reversal markets, and I've been able to take advantage of a fortune of trades. The euro pound came off on a double top recently. The pound New Zealand that I showed you, where I made 1,500 pips, did a massive double bottom at the 167 area, and that's principally how I identified that trade. Now we see a head and shoulders or inverted head and shoulders price patterns. It looks just like a man and woman's head, left shoulder, right shoulder. A few months ago in the dollar yen on the weekly, I identified a head and shoulders and made $16,000 for every $1,000 that I put up. Here is an inverted head and shoulders. It's effectively just the upside down version of the head and shoulders and indicates a market that was going down. Now once it forms this inverted head and shoulders, is going to reverse the other way. Here are a set of triangles, the ascending wedge triangle. Now a lot of Forex pairs have been locked in these triangles. The dollar Swiss, the dollar CAD, both broke lower out of the ascending wedge. So again, this ascending triangle can be a continuation or a reversal pattern. And then to the right here, we have one of my favorite patterns. This is the descending wedge triangle. And I just make money hand over fist with this. You can see gold, XAU, USD broke from 2,000 all the way to 1,000 out of this. If you look at the euro, US dollar on the monthly chart, by the time it peaked at 140 and went to 105, it broke out of a descending wedge price pattern just like this. So again, I use these patterns to identify large moves in the market. These are just fancier versions of the double bottom with a little handle. I think the Australian dollar, US dollar weekly chart looks something like this. And then we have the opposite version of that with the inverted cup and handle formation. And then you see, a number of different trading channels on an ongoing basis. I have noticed many what we call rectangle tops or rectangle bottoms. When the market traverses back and forth and then breaks out, it forms one of these rectangle tops or bottoms. And then the third step, and so again, my approach is a layered approach. I think, like I said, you can go and consult any website, to see a chart pattern. But I think what I bring to the table is that I offer you a layered approach that gets you closer and closer to a high probability trade. So step 3 in my analysis is what I call the insurance day bar. And this is something that I've coined because when I see the presence of one of these bars, it tells me that the risk reward is likely to continue in my favor. And it also tells me where to place my stop loss. So it's kind of the holy grail. And so how do I define an insurance day bar? So the first definition is what I call a key reversal bar. And just like the name sounds, this is a bar that indicates this was a market that was cratering lower, all of a sudden can't find any more sellers, and then reverses by the end of the day, and then closes higher. And obviously, the bigger the key reversal, the bigger the indicator that this market is about to turn or point in another direction. So when I see these, this is the same thing as the market actually points where it wants to go. And this is the kind of opposite, case where market was climbing higher, couldn't find any more buyers, reversed on a dime, and closed lower. And again, this may be indicating or pointing where the market wants to go. So there's never any reason to get ahead of a market. So many people are trying to short the stock market, and you don't really have to do that. The market will tell you when it's ready to go. And so if this pointing is, confirmed within the context of a trend or a chart pattern, then we have the beginning of a high probability setup. My other definition of an insurance day bar is what I call the inside day bar or the narrow range day bar. So just like the way it sounds, you can see that the low and high of this current bar is within the high and low of the previous bar. You can also see that the range is much narrower from low to high. So that's why we call this an inside day bar, because it literally sits inside the range of the previous session. And this is a coiling effect. This is what I have defined as kind of a beach ball effect. So picture, if you will, you take your hand, you compress a beach ball underwater further and further, you build up energy, you take your hand off, what happens? It just explodes out of that energy. And this is what you often find in the market. And this is an example on the other side where you have this storing of energy, this inside day bar, we have the key reversal, and then this small inside day bar. Now, you don't have to have the inside day bar preceded by a reversal bar like you see here, but if you do get one, it's usually a great tip-off that the market is about to explode in the direction that it's pointing. So now, even when I've seen a trend or I see the chart pattern forming, and then I've identified my insurance day bar, inside day bar, key reversal bar, I don't just wade in. I just don't jump in. I layer it with the final step in the form of an execution order of a resting or pending order. So this is a buy stop in a market that we're looking to go long, or a sell stop order in a market that we're looking to go short. And the pending order, requires the market to confirm my entry point. So every step up until this juncture is very subjective. It's my analysis, my analysis, of a trend, my analysis of a chart pattern, my kind of funky analysis of this insurance day bar. But ultimately, the market is always right. The market is 100% right. And so the pending order effectively confirms my entry point. It also puts me in at the time and price that the market is ready to go. So let's kind of take a look at a couple of examples of that. So this is an example of a key reversal, if you will. Market, opens lower, so indicated by this bar right to the left here, and then closes on the high. So now we, looking to go long this market, and we basically what I do is I wait for the 24-hour session to close, about 5 p.m. Eastern Standard Time, and then I put my buy stop, 1, 2, or 3 pips above the high of the previous day. And then I put my stop loss the other side of unchanged, or the previous day's close, right here. So a couple of things are going to happen here. At some point, an hour later, 2 hours, or 2 in the morning, my buy stop, may be triggered. And if it goes higher, then obviously I want to see it, go higher. What I don't want it to do is break out of here, break back, and then start reversing. At some point, we want to obviously manage our account and close it out if it's going to go against us. So the stop loss it's an art. It's not a science. Again, I place it in a place that I think is outside the noise, outside the volatility. And, again, I don't want a market to go up and then start reversing against me. So, on the other hand, if my buy stop is not triggered by the beginning of the next session, I simply cancel it. So if the next session opens and starts dribbling lower and lower and never goes up, my buy stop is not triggered. No harm, no foul. Basically, we simply cancel the buy stop and move on to another trade. So this is what it could look like under real market circumstances, and I realize this is just a cartoon on a page, but I, will show you trade after trade that, I've traded like this and made a healthy dose of profit. So we have our key reversal, we have our inside day bar. I effectively would put my buy stop just over the high of that inside day bar, put my stop loss at some reasonable place on the other side of unchanged, and then hopefully we see market action like this ensue. This is an example of a market we may be looking to go short. This is a key reversal. Market made a new high, close on the low, and so I would effectively put a sell stop entry order 1 or 2 pips under the low of the previous session. I would put my stop loss on the other side of unchanged or the previous day's close, and this is hopefully what we would see in the marketplace. So in a nutshell, as I said, this is a layered approach. The first part of my analysis is identifying what is the phase or the condition of the market. Is the market going up? Is it going down? Or is it going sideways? Or is it turning from bullish to bearish or bearish to bullish? Now, if there is a reversal pattern, it's always preceded by some kind of chart pattern. Double bottom, inverted head and shoulders, descending wedge, etc. So now either I've identified the trend or the pattern in the market. Now I wait for the appearance of my insurance day bar. Either a key reversal where the market does a washout, goes much lower, recovers, closes at the high of the bar, or an inside day bar where we have this coiling effect. And so now once I've identified all of these 3 phases, I then layer it with an entry, an execution order in the form of a buy stop or sell stop, resting or pending order. And that is my layered approach that gets me closer and closer to a high probability trade. So let me take a look at some prior trades that I did, show you some real trade examples. Again, these were all emails that were sent out. These were all trades that were taken by me and thousands of people around the world at the time. And I remember this trade well. It was right at, on the day of the U.S. elections. This was in the euro versus the British pound. And it's kind of counterintuitive because, when you say to yourself, well, what is the phase or the condition of this market? It looks like it's going higher. But at some point when it hit this peak, prices stopped going up. And I, posited to myself that this was a market that was turning, that it was going from bullish to bearish. And again, just because I thought that, I didn't just automatically wade in. I waited for the appearance of a chart pattern in the form of this double top. So again, this is the double top that I was looking at. And then within the double top, I noticed my inside day bar where the high and low was within the high and low of the previous day. And then I sent out my email that night on the euro versus British pound with the sell stop under the low of the inside day bar at 88.76. This was the parameters of the trade at the time. I had a 42 pip risk and I had 159 pip reward. As you'll come to see, I actually expanded that and took a lot more out of the market on that trade. So that was what the trade looked like. That was what the chart looked like. We had the double top, inside day bar. I had my pending order under the inside day bar. And then this is what ensued after that order got triggered. My entry was hit. And as you can see, the market went much higher initially. And then afterwards, the market came crashing down. And so the entry order, the sell stop, puts me in at the time and price that the market is ready to go in my favor. And then I got out with a 250 pip, 58 pip gain on that trade. So again, this is a different market. I asked myself, what is the phase or condition of the market? This appeared to be a market that was turning. I saw the double bottom down there. I was waiting for my insurance day bar. Everything lined up, and then there it was, this huge outside reversal where the market made a new low, closed on the high, and I sent out my email that very day in the pound yen with the buy stop at 131.75 with a 4-to-1 or 3.5-to-1 risk-reward ratio on that trade. As you'll see, I came to take out much more than that. So there was my double bottom, my key reversals, my entry, and this is what happened on the trade. So initially, I increased the take profit as the trade kept moving in my favor to 452 pips. The market kept going up. I increased it again to 543. I increased it ultimately to 652 pips where it was triggered. Also notice on that particular day I had other trades outstanding with 715 pips in profitability on those cumulative trades. So that's where I got out of that trade. Again, this is an indication of a market that's going down. What is the phase of the market? It's obviously going down. I look for my inside day bar. You can see that very small range bar. I don't know if you can see it clearly on your screen, where the high and low is much smaller than all of the others. And then I sent out basically a email to sell the dollar yen at 102.31 with a 4-to-1 risk reward. And you can see this is what happened after the trade was triggered. So obviously I don't win on every one of my trades, as I shared with you. Here are a bunch of trades that I lost on. In dollar Swiss, I lost 54 pips. Odd yen, I lost 55. New Zealand yen, I lost 42. But, you can ultimately see that the average loser in this example is 50 pips compared with the average winner of 354 pips. And that means that one winner can make up for 7 losers. So in my professional opinion, being able to lose more than you win, yet still come out with consistent profits, is the holy grail to trading. You don't have to worry about being wrong or making a mistake. You don't have to worry about a string of losing trades. You know that this is simply part of the business we're in, and understanding this is what will give you true lifelong financial freedom. So I don't know if there are any questions at this point. I'm happy to take some questions. I'm happy to even go in the live markets and overlay some of my analysis if that's what some would like to see. So I'm going to turn it back over to the moderator now. We do have an offer on the table. If you would like to follow this price action, price pattern trading methodology, I am offering today a bundle. So if you went to our website and signed up for any one of these, it would cost you 60% more than what we're offering this as a bundle today. So the first part of the bundle is what we call the Master Pattern Trader. These are live sessions that take place every Friday at 11 a.m. Eastern Standard Time. We have literally hundreds of people from all over the world join me on these sessions, and basically I go through the markets live. I go through 20 or 30 FX pairs, gold, oil, some of the stock markets. We break apart the technical patterns. I kind of size up what I think is going to happen in the week going forward, and then it's a very interactive. Frequently, people ask their questions, submit any trades that they want me to look at, and people love it. Like I said, when you go to this link, you will see other people's reviews. So I'm not going to, oversell something. I think it basically speaks for itself. We have hundreds of people around the world, and they universally love the format. Also part of the bundle is the accelerator, which is the trade of the week, which included that pound New Zealand that went for over 1,500 pips in March and April. I also do a weekly video every Sunday, 20, 30-minute recap of the markets of the week prior, as well as my thinking going forward based on the patterns. And then I think this is where the real value is. Once you sign up to the bundle, you get access to our members area, which includes 2 years of emails, my daily emails, all my weekly video reports, all the live sessions of the Master Pattern Trader. So it really accelerates your learning and what we're doing. So again, go to the Pattern Trader. I'll just put this in the chat box. thepatterntrader.com/trade. And again, you can read a number of reviews there to see if this is something that is for you. We also have a money-back guarantee, so that if this isn't for you, we certainly not looking to keep your money. So I'm going to turn it over to the moderator now. So Steve says, what gets you out of a trade that you are winning on? So basically, I look for the market to put me in a trade, and I also look for the market to take me out of a trade. So for instance, let me share with you a trade I did a little while ago in the pound versus yen. And let me just add a little bit of time here. So this was, I'm going to need to add a little bit more time just so I can. So this was the pound yen, and originally I showed you the trade that I got in down here on a double bottom. So I got in right here with this huge key reversal at this double bottom area. So you can see it's not only the price pattern, but also the price action, where the market made a new low, closed on the high. I put my buy stop here, and then once I started noticing that there was, you know, a resistance, I started getting out. I got out right in this area, and I forfeited about 300 or 400 pips, but I made 652 pips on the trade. And then once I noticed that double bottom pattern, that was effectively the governing pattern that was guiding me in this market. So once we have a double bottom, it tells me that the market has bottomed and will likely go higher. So then we formed this descending wedge price pattern, which inherently, you know, is typically a bearish price pattern that indicates a reversal. But when it busted right here, and this is getting a little bit more complex, and I don't want to really get into the weeds too much, once it broke through that, then I knew that the trend was going to resume and go higher. And it was only here that I got in. I saw this key reversal, market made new low, close on the high, and I got in here on an entry, I think 142.67. And so for somebody who asked, where do I get out? I saw that there was a natural resistance point here. So I put my take profit right there, 147.77, and I made 510 pips on that trade. But I did sit in it through all these days, probably 11 days. So it does require a little bit of a patience and discipline to hang in these trades. But the patterns tell you which side you need to be on so that when things get a little hairy, you can, you know, stay and stick into a trade. So Kay Bell says, can you send this lesson as a video by email? Can you send this lesson by email? So again, I don't know what TradeThirsty is going to do with this, but if you would like to sign up for the bundle, then I go through everything very much in detail on my Master Pattern Trader sessions every Friday. So Raj says, what time do you trade? So typically I enter my trades after the market closes. So like I said, for me, the close is everything. So I wait for the session to close. So in this case, the market made a new low and then closed on the high of the day. So I waited for the session to close, and then I put my entry above the high of that day. So I typically wait till after 5 p.m. Eastern Standard Time, and then I put my buy stop and sell stops once the bar has closed. So Abby says, are you trading live at any time? Well, that's what I do, Abby. That's what the Master Pattern Trader sessions are. They are live every Friday. So the Master Pattern Trader is 11 a.m. every Friday. So four times a month, 11 a.m. Eastern Standard Time. We join each other. Again, hundreds of people all over the world, and we go through the markets in detail. I basically start at the top and go through all of the major currency pairs, the global stock markets, oil, gold, and many others. And so you're alerted to what the opportunities are in the week going forward. So Anise says, do you use candlesticks in your analysis or indicators? I don't use either. So T. Murphy says, do you trade more stock currencies with programs? So I do trade. Again, you can use this price action, price pattern methodology to trade stocks, futures, or FX, because we're just we're trading human behavior, and human behavior comes in a market and creates patterns. So I can show you, the same kind of patterns. Like I said, here's the descending wedge on the Euro monthly that I made just a ton of money. Where was it? So here's the descending wedge pattern, and let me show you how these patterns reoccur across many markets at different times. So here's the descending wedge on the euro versus the US dollar. Slanting downtrend line, horizontal line connecting the lows, and then within this price pattern, you'll notice my key reversals right here. Market made a new high, close on the low, made a new high, close on the low. So there was your double top right there. Here was another, made a new high, close on the low, made a new high, close on the low, and this is where I went to town. Made a new high, close on the low within the context of this descending wedge, and I just made a ton out of that descending wedge. Here is another descending wedge in spot gold, the monthly. You can see once it completed this descending wedge triangle, it went from $2,000 all the way to $1,000 out of that descending wedge. Now, for many months, I've been telling my members that the dollar had peaked, and again, I used the same analysis where I saw this descending wedge triangle on the dollar index. This is basically a basket of currencies against the dollar. And so it's a proxy for the dollar, and you can see this reversal triangle right there where the market just, kept on stair-stepping lower, making the sloping downtrend line against this horizontal line, and now it indicates a market that is going to, I think, go much lower. So Bob S. says, can your system be used for options in stock? It can be used to analyze any financial instrument. So Barbara, a lot of people are asking you what the price is. If you go to that link, it will tell you the price. So a lot of people are asking, what is the price? Here's the link, thepatterntrader.com/trade. I did put that in your chat box, but I see that it's for organizers only. So I'll put it in the...
Mark, I'll do that for you. You can keep taking questions. I'll pop it in there for you.
Okay, so Kushal says, can this be applied to other markets? And yes, Kushal, again, we're just trading human behavior. Price is just a reflection of behavior. How much is a pip worth? David asked. The value of a pip is dependent on a couple things. First off, it's dependent on the currency, and it's dependent on the size of your lots. But I can give you a very good risk management tool and also a risk calc. So this is basically how to calculate risk. Can I put that in the chat box there?
Yeah, just pop it in there and just click send to all. Like select somebody's question in the questions box and type the answer and hit send to all, and everybody will get it.
Got it. Send to all. So this is a position size calculator. So independently of whether you take my trades or your trades, you should be using this position size calculator. So I'll take you through very simply how it works. And this is how you can assess your risk on every trade. And anybody who doesn't do this is, just setting themselves up wrong. So again, you can basically do the risk on any denomination where you are in the world. If you've got a pound or a euro account or a yen account or Australian, I'm going to assume a US dollar account. Let's just assume a $5,000 account size. I typically recommend a 0.5% risk on every trade. A lot of you are trading with 3, 5, 10% risk, and you're eventually going to get wiped out doing that. Here, that's how you designate 0.5%. It's 0.5. Let's say my average stop loss is 57 pips, and let's just arbitrarily choose, a pair. Now, the nice thing about this position size calculator versus others I found on the internet is that it automatically calculates this offer price. Typically, you have to go find this, put it in manually, and then you simply hit the calculate button, and this tells you exactly how many lots you can place in order to risk a 0.5% on your account on a odd yen position, short or long, with a 57 pip risk with a 5,000 account size. And even if the wheels come off, you're going to lose $25 or 0.5% of your account. Now, under this thing, you can also go to Forex calculators and find the value. So pip calculator. So this will tell you what the value of a pip is. And again, I'm not going to spend a lot of time here. I'll put this in here also. So the value is, again, a function of the currency, like a pip in the euro. If the euro goes from, let's see, from wherever it is now, 116.63 to 116.64, that's one pip. And that's typically $10 if you're trading a big size lot, and $1 if you're set, you know, a mini lot, and then 10 cents if you're trading a micro lot. So again, use your calculator to calculate your lot size depending on your account size. So whether you're trading with $500 or $500,000, you should use that risk, because a 0.5% risk in a $500 account is still the same as a 0.5% risk in a $500,000 account. It's 0.5%. So I think a lot of people are misinformed about risk and equate risk to the number of pips they're risking in the market. What is a pin bar? That's a key reversal bar. Davey says, what is a pin bar? So to my mind, a pin bar is the same as a key reversal bar. And there's so many times where the market actually points where it wants to go. Here's my favorite. This is where I made 2,000 pips for my clients recently on the pound New Zealand. So again, a key reversal is, to my mind, nothing more than recognizing or noting how a market closes relative to the high or low. So when the market closes at the high part of the bar, again, at a very strategic point, it tells us that the market washed us out, and it also suggests that the market points where it wants to go. So all the way back here, even though the market was at a new low, I was putting out videos and emails alerting my members to the potential of a significant turn in the market. And it wasn't only because of that key reversal at that point, but it was where it occurred at this double bottom low. So we had two prices at the same low, and then this one made an all-time new low and then closed on the high of the bar. And then I bided my time, waited for the market to basically coil around, and when it came down here, then I knew it was go to the bang time, where basically the market made a new low, closed at the high, made a new low, closed at the high, and it was right here, March 5th at 175.09, at an entry right above that bar that I sent out that email. And we stayed in that trade all the way till there and made 900 pips on that trade. So it's a combination of both price action and price patterns that puts me on the right side of the market. So Joe says, how many trades do you have open at one time? So I'm very selective, Joe. Probably no more than 3 or 4. I typically trade once or twice, send out 1 or 2 emails, 1 or 2 trades a day, and many times there are no trades. You'll notice for July, I've been trading very selectively. We're almost through most of July, and I've done 1, 2, 3, 4, 5, 6, 7, 8 trades. So again, it's trade quality, not trade quantity that I'm looking for. So average, I'd say, is 20 to 25 trades a month. A lot of you are asking if a recording is going to be available afterwards. I think your moderators will be able to answer that. Okay, so I think that's basically it. So Stretch says, are you in dollar CAD? So I've been advocating a short position in dollar CAD for quite some time. We pointed out these ascending wedge chart patterns. Again, on my Sunday videos and my weekly Master Pattern Trader sessions, I alerted my members to this opportunity quite a while ago, because we saw that dollar CAD was locked within this ascending wedge triangle for quite some time. We had a false breakout, which I also kind of noted. When you see this key reversal right here, market made a new high, broke out, and I thought it was a false breakout, and I was alerted to that. And then when I saw a bunch of inside weak bars right here, I said that any break below here would probably open up a nice move, and then we saw another inside day bar there that broke out the the ascending wedge, and now you're right at where I thought we were going to go, right back to the 124 support. So I was calling the this dollar CAD move several weeks ago, and you can go and reference my past emails and video reports, which are in our members area for that. So I'm not retrofitting this analysis. And this is what I look to do. I look at the chart pattern, and then I look within the chart pattern at the price action. So I look at this what I call key reversal, where the market makes a new high, closes on the low. Again, that was pointing in the direction where this market wanted to go, and look what's happened after that. Same thing here. Market made a new high, closed on the low, and look where it was pointing. So again, you can't just do this indiscriminately. You have to look at the major trend and or the chart pattern that's emerging, and I've become quite adept at doing this. And if you'd like me to help you grow your account over the next 12 months, just go ahead and click this link, thepatterntrader.com/trade, which includes live sessions, the trade of the week, my weekly video report, and then archives of all our videos and emails for the last 2 years. So I think that's it for me. I don't see any more questions coming through. David says, do you trade the futures? I used to. I was a commodity futures broker for 20 years, and I used exactly what I'm showing you here on the futures markets.
Hey, I'm here, Mark. I'm ready to take over if you're done.
I think that's it for me. Thank you. Yeah, and thank you for allowing me the opportunity.